Hi everyone. Peloton reported fiscal year 2023 second quarter earnings results this morning. So I went through these results and tried to decipher how these results configure into Peloton's recovery plan. So let's get an inside look into what's going on with Peloton stock. So the turnaround is progressing. Yes, overall revenue decreased by 30% in the second quarter to 792.7 million. This was a little bit disheartening. Net loss of 335 million was an improvement from a loss of 439 million in the same quarter last year. And if you're unfamiliar with Peloton's story, it was a pandemic beneficiary. It thrived during the pandemic, sales soared, and then the management team at the time thought it to be wise to invest in expanding capacity so that it can expand sales, right? It had international plans, it had new product plans. It said let's go all out. Let's invest, let's build out our capacity. Customers love our products. It's not just because of the pandemic and gyms are closed. This robust demand is going to persist even when economies reopen. Sadly, that was not the case. As soon as gyms reopened, customer orders for Peloton's exercise equipment crashed. And so the company made those massive investments in building out capacity in a way that was difficult to reverse. It didn't make these uh, tepid investments where it could reverse them or reduce them when demand fell. It made big investments. It paid over 400 million to buy Precor, a manufacturing exercise equipment manufacturing company. It made a commitment to build out its own $400 million manufacturing facility in addition to the one it just acquired for $400 million. So it made these big, huge investments. And so that started to weigh on profitability as sales were crashing down. And so the company needed to have a very fast, very quick reversal of that strategy, which is not easy to do. They brought in a new CEO, and the new CEO said, yes, we're going to work on a turnaround, but it's sort of like turning around a massive ship in the ocean. Even if you turn it, it takes a while to see the progress of the ship moving because it's so big and massive. That's what's going on with Peloton, is that these investments were so big that it takes time to move away from those. And this is what you're seeing here with the losses, with the revenue decreases. The good news here is that it ended the second quarter with 3.033 million connected fitness subscriptions. This was up 10% year over year. When you buy a Peloton bike or treadmill, it comes with access to live and interactive classes, which you have to pay for $49 per month. They just raised those prices. And so it's good news to see that the number of subscriptions increased even though they raised prices. This means that customers are not canceling. This is good news. And this is likely to persist because if you pay $1,000 or $2,000 for one of Peloton's bikes or treadmills, you're not going to want to cancel your subscription of $49 a month when you already paid a big upfront fee for the bike, right? And you're only going to cancel that if you're really, really not using it, right? If it's really just turned into a decorative item in your house where you just have it on display and you never really use it, then it might make sense to, okay, let's cancel the subscription because you know what? We thought we were going to exercise, but turns out we're not really going to exercise, so there's no point in paying for this subscription. Thankfully, that's not happening. So the connected fitness gross margin, negative 11.2%, was an improvement of a negative 27.2% margin in the previous quarter. So this is due to having all of that capacity, the higher cost of goods overall when you're selling these bikes because of those massive investments. The new CEO is working to bring those down. It's going to take time. They were planning on selling the Precor company that they acquired, the previous management team acquired for 400 something million. But the new CEO says that, hey, you know what? When we went out to sell this company, turns out the market price of it was much lower than we thought. So we didn't sell it because the price was too low. We were going to take on such a big loss for selling it. So we decided to keep it. So this is part of what I mentioned earlier. It's difficult to turn around these massive investments. It's difficult to say, it's not like when you buy something from Amazon, when it gets delivered to your house, you try it on, you don't like it, you say, all right, let me return it, and you get your money back. That's not the case when you make a $400 million acquisition. You can't just take it back and say, hey, can I get a refund? So that's the difficulty Peloton is having with these over investments. Total operating expenses of 566 million was down from 706 million year over year. So that's excellent progress, bringing down operating expenses. Anything that was discretionary, sales, marketing, employees, whatever they have in discretion over, whatever they can bring down, they've been bringing down. So the new CEO is prioritizing cost cuts, which is prudent in my opinion. Cash used in operating activities of 88.5 million and a cash outflow of 94.4 million was a massive improvement from the 447 million and 547 million outflows in the same quarter last year. So significantly bringing down the cash burn. That's important because they're not what you would call robust in terms of their cash balance. So bringing down the cash burn will give them more time to execute this turnaround. And at a pace of 88.5 million or 94.4 million, that gives them a lot of time. That gives them several quarters to work through its excess inventory, to work through the higher cost. So more progress there. And the company's forecasting 3.09 million connected fitness subscribers for Q3. That's an improvement from 3.033 million, so that's good news. Sequentially, they're going to be adding more subscribers. Those are high margin revenue sources, so that's really good news. Revenue decrease of 27% in the next quarter. That would be better than a revenue decrease of 30% in the second quarter. And total gross profit margin increasing by 2,000 basis points to 39% compared to the previous year. So more sequential improvement. Excellent progress. So really good progress here from Peloton, except for the news about selling Precor and divesting from those over investments during the pandemic. That was bad news. However, the market is kind of ignoring that news. The stock was up double digits following the announcement of this earnings report. So the market really likes what they saw from Peloton here. I think that this new CEO is so far doing an excellent job. Let's hope to see continued progress here of this brand that's really loved by its customers, right? But it's just management just misread the pandemic boost in demand, and so this new management team has to come back and kind of fix the overconfidence of the previous management team. All right, that's all I've got for this video. Thanks for watching. I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.